Not every economic data point of the past several weeks has been poor, but several do suggest that the economy is slowing. And we're going to discuss that and a company that is set to report earnings today on open interest. Hello, everybody. Hello, everybody. I'm Mike Coe. Welcome to Open Mic. Earnings season occurs 4 times per year when many publicly traded companies release quarterly earnings reports, providing investors with detailed financial information such as revenue, profit, earnings per share, and other vital metrics. Historically, Alcoa marked the start of earnings season, being one of the first major companies to report results. However, in recent years, large financial institutions like JP Chase, Citigroup, and Wells Fargo have often been the first to release their earnings reports, signaling the start of the earnings season. All 3 are reporting this week. And while their results will be closely watched, these stocks have typically shown only modest movement on earnings. JP Chase averages about a 2% move. Citigroup and Wells Fargo are slightly higher at about 2.5% and 2.4% respectively. On the other hand, Fastenal has an average earnings-related move of more than 4.3%. It has underperformed the S&P year-to-date, down nearly 2.5%, and has declined by about 20% since the late March highs. And Fastenal is a US-based industrial supply company that primarily deals in the distribution of fasteners, including screws, nuts, bolts, and related hardware, as well as a wide range of industrial and construction supplies. The company operates through both physical store locations and online platforms, serving a diverse customer base, including manufacturing, construction, and maintenance industries. Fastenal is a US-based industrial supply company, and it holds a unique position in the market, and its products, used across various industries, offer a comprehensive view of economic activity. The company's sales data, reflecting real-time demand for industrial and construction supplies, is closely linked to economic health. Increased purchases of fasteners and related products usually indicate heightened production and construction activity. With its widespread locations, both in the United States and internationally, Fastenal's performance also can provide valuable insights into regional economic conditions. The recent weakness in Fastenal's stock price is a reflection of near-term challenges from soft manufacturing markets. While last week's non-farm payroll data seemed positive at a high level with 206,000 new jobs, a deeper analysis revealed that 82,000 of those were in the healthcare sector and another 70,000 were government jobs. Manufacturing jobs actually fell by 8,000, contrary to expectations of a modest increase, further contributing to the challenges faced by Fastenal. Top-line revenue growth is less than 4%, which is in line with GDP growth, and margins have remained steady at just over 15% over the past several years. EPS growth has significantly lagged behind overall earnings growth for the S&P, making it difficult to justify the company's 29 times earnings multiple, which is a premium compared to the S&P 500, which is trading around 23 times forward earnings, and its peers, which are trading around 20 times forward. The most recent 13F filings from March 31st show that many hedge funds reduced or unwound their positions in Fastenal during the first quarter, and those who did so may be waiting to repurchase at previously attractive levels, but we're not quite there yet. Given the expectation that the stock is unlikely to rebound on earnings, a calendar spread could be a suitable trade. Fastenal, due to some corporate actions, has unusual front-month strikes. For example, the first out-of-the-money put strike, expiring in July anyway, is the 62.12 strike puts, priced at about $1 a quarter contract as of last Friday, and this premium could finance the purchase of longer-dated November 62.5 puts, whose mid-market price was about $3.25. And this trade would capitalize on the typical volatility crush following an earnings report, offering a potentially profitable strategy. And I just want to offer a sort of a crucial public service announcement when executing spreads like these. Calculate the mid-market price and then use a limit order. The bid-ask spread for the front-month options is reasonable at just a dime, while the November bid-ask spread was about 30 cents, making the effective bid-ask spread about 40. And the mid-market price on the spread is $2. So if you buy that longer-dated option at about $3.25 and sell the nearer-dated one for about $1.25, that nets out to about $2 in premium spent. But if you pay the offer, you're going to end up paying $220, and that's 10% greater than the mid-market price. So using limit orders is particularly important when the bid-ask spreads are wider, as they are here. So first of all, I just wanted to talk a little bit about this company and their history. So it's kind of remarkable. I think we talked about this stock a couple of years ago. Carter Worth and I did. If you're not familiar with it, it actually does represent one of sort of the more phenomenal appreciation stories in modern history. And actually, I'm just going to pull up a quick chart of it so that we can get some sense of that. I know that many of you prefer candle charts, so that's the one I'm going to use here. And if we do this, this will be a non-logarithmic chart. You'll get some sense of the remarkable appreciation that this stock has seen. And actually, to put things in perspective, if we compare this to the S&P over the same time frame, or maybe I should more appropriately, let's take a look at, well, we'll look at the S&P first, and then we'll just take a look at industrials. So this chart here on the top is going to have the price charts for both. And let me normalize this. And this one on the bottom is so what I've done here is I've basically normalized both of these. So the bottom one here actually represents the spread, the difference in price appreciation for Fastenal versus the S&P going back over this period of time. And you can see it is remarkable. In fact, I think the point that Carter had made when we were talking about this stock a couple of years ago was that actually its price appreciation mirrored more closely that of a name like Microsoft than it did the S&P itself. So really a phenomenal growth story here. The issue for me is not the long-term historical performance for Fastenal, but rather whether or not it justifies its multiple here and now. So this chart that I'm showing now is basically the growth in net income for Fastenal over the course of the last 10 years. We can see, it's certainly respectable, to be sure. We can also just take a look at the growth in revenues as well. And actually, you should expect this to be, vaguely similar. Unsurprisingly, as I pointed out, at least over the course of the last 5 years or so, the margins for the company have remained relatively constant. The issue that I have, though, is that at 30 times forward earnings, this is not cheap. Even though it has fallen 20%, as I mentioned, from the March highs, it still isn't cheap. I also referenced, I think this is kind of interesting, what some of the sort of fast money accounts, which I'll describe as the hedge funds, have been doing. And so we're just going to take a quick look now at the holders list and take a look at those that, you see a lot of real money accounts, so mutual funds and index funds have been adding. But when you take a look at who's been reducing their positions as of the 13 Fs that were filed most recently in March, and you can see that there are several here. We've got Cube, Volridge, Millennium is in here. You can see that these are substantial. Millennium, you can see they sold virtually all of their position, 99% of it. Confluence, which was a seller, probably has sold a good deal more. Murray, you can see they sold about 10%. And as I mentioned, Cube, Volridge, they've essentially gotten rid of their positions. And, one of the things, if you take a look actually at their sales, and I'm talking about the sales of their stock positions, you'll observe that they were quite remarkably well timed, and they may have actually precipitated some of the losses that the stock has incurred since those March highs. So what is the economic data that I've been referring to other than some of the data like the employment data that we got last week? Some of the other data that we've been getting, we can go back, maybe we'll go back a couple of weeks here. I'll just go back to the end of June perhaps, and we'll see. But some of the data that we got ISM data, for example, you can see the manufacturing data came in at less than 50. Numbers less than 50, by the way, are sort of contractionary, if you will. That wasn't particularly positive. As I pointed out, the payroll data, which saw declines in manufacturing, that wasn't particularly positive. We also got some interesting data here. We can take a look. You may not see this. I'm going to try to put my cursor on it, but if you can't read it, which I apologize because the print's going to be small, I'm sure if you're looking at this, particularly if you're looking at this on a small screen. What we're looking at is total vehicle sales, which disappointed. So we got 15.3 through June versus 15.8 being the survey. I'm going to guess that anybody who's been paying attention, driving by car lots or watching advertisements or just checking on new car prices, will observe that there have been a number of discounts and incentives being offered. Inventories for cars appear to be rising, and so you start putting all of that stuff together, and it just suggests that maybe things are slowing down just a little bit. Now, we are going to be getting some important inflation data coming up, and inflation data is going to be important because in the context of the non-farm payroll data, if we're starting to see a mild uptick in unemployment, which we did get, I think unemployment ticked to 4.1%, and we also see some stabilization in prices. I'm not necessarily forecasting that, but we're just going to, rather than try to guess at what's going to be reported later this week, we can obviously wait and see what is. But if inflation pressures do moderate a little bit, that does create an upside potential catalyst because it would help the Fed justify reducing rates. So one quick point about that, which I think is kind of important, and that is that, of course, Fed policy has been restrictive when we are looking only at recent history, the last 15 years or so, since the GFC, since the financial crisis. Of course, in a longer term historical perspective, rates really are not that extraordinarily high. They're obviously nothing like what we saw with Paul Volcker in the early 1980s, and we can just take a quick peek at that. If we imagine that the 10-year rate is really kind of the benchmark for the larger purchases, and we just take a look at a long-term historical chart of that, and then we put that into context, what we're going to see is that, sure, it's much higher than it has been recently, but where it has been recently, meaning over the last 15 years, has almost nothing to do with where those rates would have been over the long term. So I'm just going to get it right. So this line, if I can get it to stay there, well, it's close enough. So this white line, I'll try to make that a little bit brighter. So if you can see that, that white line represents approximately where 10-year rates are now. And if you look back in history, so we're going basically back to the post-World War II period here, what you're going to observe is that the rates that you're witnessing are effectively still actually very low. 4.4% in the 10-year is relatively low. If you have 3% inflation, you can see that the real rate of return then on a 10-year treasury is going to be about 1.4%, and that's not outrageous. Now, it's the short-term rates that we're really also talking about. So, the Fed can control rates at the short term, it can control them at the long, and usually when we think about the short-term rates, what we're talking about are things like Fed funds, and the Fed fund rates are higher, so we have still an inverted yield curve, over 5% right now. If the short-term rates come in theory, that is good for the banks, because if we imagine how the banks operate and where their net interest margins are derived, they borrow short and lend long. So they borrow by collecting deposits. They pay interest on those deposits. The interest on those deposits is going to be controlled by the short end of the rate curve to a degree. This is a little bit less true now than maybe it would have been once upon a time. And the reason for that is that it does appear that some banks, those that are deemed too large to fail, aren't compelled necessarily to pay the most competitive rates because large depositors are inclined to put their money into institutions that they think are not at risk. So unsurprisingly, if you take, what would be the best bank in that space, I think we could safely say that that would be amongst the US banks, JP Morgan. And one of the things we can observe if we take a look at JP Morgan's results, let me see if I can blow this up a little bit here, make this a little bit easier to see. So I'm going to take this up a bit. And what we can see actually is that JP Morgan's results over the last couple of years have actually been quite good. I don't really expect big moves, I have to say, out of either JP Morgan or Citi or Wells Fargo. I just happened to notice this. I thought it would be kind of an interesting thing to think about as we contemplate the different banks, though. Number one, JP Morgan operationally has been doing quite well over recent years. They do not appear to be materially affected by the rate picture, as we can see. Revenues are up substantially, as is EPS. Another important point, and that is, and this isn't always immediately visible. So when you take a look at a bank's balance sheet, and I'm sure we haven't talked about this kind of thing as much lately as we were talking about it when a rate sort of spiked up. And I'm actually talking about the 10-year rate, so going from sub 1 up to 4 or 5%. And it's this line item right here that I'm highlighting, and that's the held to maturity securities. So banks are, when they're looking at that portion of the assets that they're holding on their balance sheet, they are not marking those to market. And if you have a big bond portfolio and rates go up 300 basis points, and you have a lot of duration in that portfolio, the value of those assets in real terms, the market value of those assets has declined precipitously. That's exactly what happened for some of the big bank failures that we saw. We're talking now about the Signatures and the Silicon Valley banks. That's the problem that they have. And amongst the big money center banks, some banks did not manage their rate exposure very well at all, and almost astonishingly badly, I think one could say. Bank of America would be an example. You can try to hedge out your duration risk or not take that much of it on. Bank of America, for whatever reason, seemed to take on quite a lot of duration risk when rates were exceptionally low. So effectively getting short rates when rates were at all-time lows, 10-year rates were at all-time lows. Hard to imagine why they would do that. Now, I should maybe back up a little bit and say, here's how and why it happens. If you take in a lot of deposits, this was the case with Silicon Valley Bank, for example, you need to put those deposits somewhere. They bought treasuries. I think that was just sort of a blind force of habit. That had for a long time been a fine thing to do, because if you live in a world where rates are doing nothing but declining all the time, then number one, you're earning some yield. The assets are treated as good as cash from a regulatory point of view. And you also have the tailwind of falling rates until you don't. In any case, I just bring this up because I think Bank of America and JP Morgan are very different. So in all of this history, you can imagine that if you operated a bank, you took in deposits, and all you did was simply buy 10-year treasury bonds with the proceeds of that, you've done just fine, because you were essentially just taking a big short rate bet and hopefully earning some form of a spread on it as well. And you just basically rode a 40-year bull market. On the other hand, here we are in a situation where rates are going the other way. So what is interesting to me is that what is going to happen if we get some form of normalization? Who is going to be a better beneficiary of that? Is it going to be JP Morgan, which I think has managed their affairs reasonably well during this time? Or could potentially you have a situation for the Bank of Americas of the world? You can see that rates sort of, they got up here and then they've sort of stabilized a little bit. If the long end of the curve stays here or potentially moves a little bit lower, why would it do that? Economic weakness, lower inflation, some combination of these things. And arguably you could suggest that even though it's not taken as an income or loss hit, I should say, on their income statement, the fact is that most investors, including you, including me, we understand that they have a big portfolio of assets, and that those portfolio of assets are deeply underwater and would potentially benefit in the event that the long end came down. Now, I don't know how much they can actually do about that, but it's just something to think about, that we've had JP Morgan materially outperform Bank of America for some period of time here. And let's actually just take a quick peek at this. So I'm going to just put Bank of America in here so you guys can take a look at the sort of the difference between how these two have performed. I'm going to need to do a little bit of normalizing here. And we'll go back a couple of years. And you can see that JP Morgan has outperformed Bank of America by nearly 30%. And actually, if we go from this point, which was really the beginning of that sort of bear market that we got in 2022, so that was February 7th. We'll just put that date in just to take a look at the relative performance since then. You can see that, oops, did I do that correctly? I must have put the wrong date in there. Oh, whoops, that's the wrong year. My mistake. There we go. Yep, so you can see that JP Morgan has outperformed Bank of America by almost 50% since the bear market began in early 2022 as rates rose. Okay, so, oh yes, I might as well just quickly show the trade. I'm gonna, I have to say I was looking on the OptionPlay app. I want to just put this calendar spread in really quickly, if I can, so you guys can get a look at it. But I did notice when I was looking at this earlier, and that's one of the reasons I was reflecting somewhat stale prices when I was referring to it, because OptionPlay is actually the application. Whenever I'm trying to check prices, even though I have stuff on the Bloomberg terminal, I will typically use OptionPlay just because it's quicker and easier to visualize things. I did notice that it didn't seem to like some of those funky front month strikes. So it's working now, it looks like. So what we're talking about then was selling this first out of the money put strike, which, as you can see, as of the most recent price, was actually a little bit higher than what I had reflected when I made my comments earlier. And then we'll just go out to November. We want to buy that. This is not going to have those same strikes, so those are going to be the 62.5s. And this, there we go. Okay, so this is what that trade ends up looking like, right? So if you get a move post earnings that is, and really it's not post earnings, because what I'm talking about here, this doesn't have weekly options, so we're really just looking at the July regulars. But if you get a price move that is between 58.5-ish, let's say, and 66 bucks to the upside, that's the zone where you're going to experience some profits. Peak profits obviously are going to take place, at that front month put strike, so around 62.12, and you can see that versus the prices that I cited earlier. This is largely because the delta of the two options is the same. Hasn't changed much. I think I said it was about $2 for that spread. 202 is your number. Okay. So with that, just talking about that, I'm going to, by the way, talk about another sort of industrial logistics and transport story when we do the live stream on Wednesday. Just a quick point there. JB Hunt, they're going to be reporting on the 16th. Also a stock that hasn't been doing fantastic of late, but I think it's kind of interesting. Okay, so let me try to take some questions here. The first one comes from Al Gover, and his question is, hi Mike, I have a position in Intel, covered call, July 19th, 34s. Let's just take a quick peek. We'll load that up. Oops. And I don't think it took the last letter that I put in, so give me a moment. Oh, it did. Okay. All right. So you are, well, first of all, you're in a great position out of today's big up move. I don't know whether your Intel position was a long-term position that you happen to hold, and you've just been writing calls against it. But these are the July 34s. So, look, I mean, not a terrible position to be in right now. Obviously, the stock move, running right to that strike probably has you wondering whether or not you need to do anything. But just consider this. Yeah, so I would let this one, I would stay in this position for the time being. So first of all, these are going to expire a week from this coming Friday. Your standstill yield to expiration, which is one way to think about this, is about a third of the current stock price. So no real reason to do anything. But I will say this, and this depends a little bit on your tax situation as well. And everybody's tax situation is going to be a little bit different. Selling a covered call, you don't want to take assignment if it's going to trigger an unwanted tax consequence. So let's just say, for the sake of argument, that you own the stock at 30. It was trading there recently, just about 6 weeks ago. It was trading about 30 bucks. Actually, even more recently than that, probably ticked around $30. So here you are, you're looking at a 12, let's call it a 12% gain in the underlying. It's a short-term gain. Do you want to take that 12% short-term gain, or were you purchasing Intel as a longer-term hold? If you were, in that case, then you might just want to wait until some of the extrinsic premium has decayed out of that option, and then just go ahead and roll or cover the call at that point. So just that would be my take there. Okay. So, Greg Forrest says, interested in data center plays, GLW might be good for long calls. Well, let's take a look. So, it's interesting. I think I saw one of the Nigerians just, it was either Pete or John Nigerian might have actually said something about Corning. I saw a tweet from one of them recently. I haven't spoken to either of those guys in several weeks, maybe more than several weeks, could be a couple months. But I know that one of those guys, probably both of them, really like this name. So that's fine. I will say, it's interesting. One of the data center plays that I like, one of my former colleagues, my former boss actually from Ivory Capital, has had a position in SMCI, Supermicro. So if you don't know the story with Supermicro, it's kind of remarkable. They, not quite, it would seem, the kind of proprietary technology that NVDA has that's so important, but the fact is, and I actually, if I had my brother on this live stream right now, he'd be better to speak to this than I am from a technical point of view. But the fact is, if you've ever been in any server rooms, you know that these machines generate a tremendous amount of heat. And Supermicro, basically their claim to fame is sort of on the heat management side. So, building servers and server systems and racks that are great at heat management. And, when I first took a look at this thing and sort of saw its explosive growth in terms of price, I thought, oh, this is just kind of some over-exuberant stuff that's going on here. But in much the same way that you sort of think about NVIDIA, the fact is that their operational success has been remarkable. And let's just take a closer, shall we say, look at that. Right now, for the period that they're going to be reporting at their next earnings results, so that's through June 30th this year, the Street's expectation is for almost 110% year-on-year revenue growth. Really pretty spectacular. And you start taking a look at multiples and you say, well, actually, is the multiple for this thing so insane when you're experiencing growth like that? And the answer to that is no, if they can keep it up. This thing is trading 26 times forward earnings, which just seems insane. You take a look at price appreciation like that and you think there's no way that the company could actually be growing that fast. But indeed, they have been. So 26 times forward earnings versus 23 times forward earnings for the S&P overall, and 100% year-on-year EPS growth versus, and I think I referred to this on an earlier live stream. We had a year-on-year S&P earnings growth of about 6.4% versus 100 versus 100. These numbers are sometimes hard to get your arms around. It does speak to the size of the investment that's being made in this space, and that there are a handful of players that really are winners at this point. Okay, Alex S. Hi, Mike. Is collar strategy a good hedge against long stock right before the earnings announcement? Is it a good idea to make it zero cost? So a zero cost collar involves selling an upside call. And I don't generally like selling upside calls going into events, oftentimes because I feel like that's when investors are going to get, if you own a stock, you probably own it in anticipation of operational results that are better than the Street's expectations. And if the price is going to reset, that's when it's going to do it. So I will say this, it depends a little bit on whether you feel like you have a strong opinion about that, or you have a not very strong opinion about that, or worse than that, you really want to hit the pause button because more recent insights have you questioning your original thesis. So a couple things to think about. And let's just build this into the app, because I think an important thing to realize about stock with a collar is synthetically you're basically trading a long call spread. That's basically what you're doing, which isn't a terrible strategy going into earnings. But the question, and this goes to your zero cost thing, the question is, would you trade an in-the-money call spread going into earnings, or would you try to trade something that was slightly in the money at or slightly out of the money rather than deep in the money? Let me show you what I mean. So, and by the way, did you have a specific stock in mind, Alex? Because if you did, I'll look at it. I was talking about JP Morgan. They're going to be reporting. Might as well just use that big options chain, deep, liquid, efficiently priced. So we'll use JP. If you want to mention the specific stock you're looking at, go ahead. In the meantime, I'm just going to use JP Morgan as an example. So long the stock, we're going to modify this trade. We're going to add a short call and a long put. So I'm going to sell an upside call. I'm going to buy a downside put. We're just going to look at the July regular expiration just to keep things simple. I'll use mid-market prices. Always think about things in terms of mid-market prices. And you were alluding to doing this at, if you could, something approaching zero cost. Okay, so the 210 calls are about $1.92. I'm looking for a put that is comparably priced, and that's going to be, we'll call it the 200s. Okay, so here we go. You buy, it's not exactly zero cost, but it's pretty close. Actually, if I just go to bid ask, now it's going to be close to zero cost. There you go. You know, hitting bids, lifting offers. So what does that trade look like? Well, remember what I said. It's basically like trading in the money call spread. So you get this kind of a payoff. So kind of a coin toss, right? Pretty much equal upside to downside. You're limiting how much downside risk you're taking. You are capping your potential upside gains. And for anybody who doubts that it looks essentially the same, why don't we just construct that exact same in the money call spread and take a look at their characteristics side by side, and you're going to see just how similar these trades are. So that was the 200, 210. So I'm just going to put the 207 and 210 calls in here. We're going to buy one, sell the other. Lo and behold, that's what you get. Okay, so it's going to cost you $5.18. Your max reward, $4.80. Max risk, $5.20-ish. Let's take a look at this. Max reward, $4.96.5. Max risk, $5.03.5. Very, very similar strategies. Okay, so these two are synthetically kissing cousins, right? These are essentially the same trade. So the question you ought to ask yourself before you do a trade like that is, do I prefer that, or would I rather, would you rather, is the game they often play on Fast Money, would you rather select something with higher strikes so you could potentially lose a little bit of money at spot, but give yourself a more asymmetric risk-reward profile. So in the other one, remember, your max reward was going to be, call it $4.90, your max loss $5.10. So now we've sort of changed that around a bit. Now the max reward is $6.90 and the max risk is $3.10. And remember, this is $3.10 on a $200 stock, so 1.5% of the current stock price. So if you're doing this, you know, one up against stock, you know, that's kind of the thing to think about. So that's another way you could do it. A put spread collar is a strategy you might also prefer. Let me illustrate that. So we're going to take this here. We're just going to modify this one a little bit and say, okay, I'm going to sell this upside call. Maybe I can stretch it out a bit, or even if I just leave it there, but let's just throw in another put here. So the stock is about 205. So if I bought the 205 puts, and if I sold a lower strike put, and those are about 353, I've got $1.90 to work with. So I do something like this. Now I'm not laying out any premium, actually collecting a modest amount at this point. I get this upside, but I actually get some near downside protection. So that's kind of the trade-off. You think about when you manipulate these trades, you're kind of squeezing the balloon of risk reward given the modest moves. Now I'm using JP Morgan as an example, so you know, depending on whatever stock it is that you're in, this may or may not be applicable. This isn't a company that moves a whole lot on earnings, so actually managing a modest downside move might actually be the play. And you can adjust those put spread strikes so that maybe you bump the strike that you're long down to, you know, 2.5%, 5% out of the money, and manipulate it that way, give yourself a little bit more upside, and just create some asymmetry so that if you think about it, you know, a 5% move higher or lower, I capture most of the potential upside move while mitigating or reducing a significant portion of the downside move, which is fine. I can also provide examples of where this idea would not have played out very nicely at all. So we had a trade in Nike. So a call spread risk reversal, all of these things, you can kind of map them against one another. They're very similar in characteristic. A call spread risk reversal is very similar in its characteristics, synthetically equivalent to stock with a put spread collar on it. I could illustrate this for you, but I think you guys are kind of getting the point. Because long stock plus long put is synthetically a call. So, if every single time you're looking at your positions and you're incorporating stock and you're adding a put as a protective measure, you can think of that as a synthetic equivalent of that long call option, and manipulate things accordingly. In general, because those really outsized moves are rare, my preference is usually to try to capture most, if not all, of the implied move to the upside, while mitigating some of the downside, but not all. Look, you're going to be taking some equity risk, or at least you should be comfortable with that with any of these trades. So, assuming you're comfortable with the stock, you're willing to accept at least some downside risk in it, these are the kinds of things you want to think about. Okay. Let's see. So I think Al still referring to the Intel, saying never thought you would see this. That kind of a move. I'll tell you, I'm actually kind of surprised too. What actually was why such a sharp move today? Did we see this? Could it be that they're finally turning things around? What was the news in Intel today that I missed? So there was a big purchase of the 34 calls as it happened. But what was perhaps one of you know why the outperformance in Intel? Because actually up until recently, AMD, of sort of the traditional chip players, that would have been the one that I probably would have preferred. Steve B. Mike, I've had puts I sold exercised against me slightly early a few times, and it's been a bottom in the stock. Is there a way to track early options exercising? Well, yeah, there is. And you can see it where you're going to see that, although it's pretty clunky, right? Because you basically have to check overnight. It's a whole lot easier if you have. Well, let's find an example. I don't know that it really matters what stock we're going to take a look at. So here's the way you do this. The first thing is that obviously you can check the open interest in a contract from one day to the next. And I did not add that. I don't have the open interest in here, so give me 1 second. I'm just going to edit this really quickly so I can add that in. So we can just take a look at the open interest. Need that. So I want. Do they have them apologize while I work through this? Because I had that as a default usually. My field categories. You know what? Let's just search this. Okay. So yeah, you can, well, obviously I can do it in the Bloomberg, but I'm sure you have mechanisms to do this in your things too. But one of the things you can definitely do is you can check the open interest on one day and then see and compare the change in open interest to the volume as well for that day. So let me give you an example. If there's 5,000 open interest on a contract on T1, we'll say today, and that contract doesn't trade, and there's 4,000 open interest in that same contract tomorrow without any trading volume, guess what? That means that 1,000 of the 5,000 in open interest were exercised. And by the way, I also want to speak to this phenomena because many people, especially if you've started trading options more recently, and by more recently I mean within the last 15 years, the zero interest rate environment that I'm talking about, or have been talking about earlier. If you've only been trading options for the last 15 years or so, this is probably not something that you've seen a whole lot of before. And the reason that people exercise puts early is because the carry cost of that position exceeds the extrinsic value of the option itself. That's the usual reason. If they're being exercised and that's not the case, it's probably because people don't know options well enough and are exercising them at a suboptimal time. What do I mean by this? Well, imagine you're a market maker and your overnight annualized cost of carry for the money that you're borrowing is 5%. Well, if I have a 100 strike put that I'm long, and I'm long the stock, and it's a $50 stock, now I am carrying $50 worth of premium, and I'm carrying $50 worth of equity, $100, so the strike, effectively. But the extrinsic value of that option, being a 100 strike against a $50 stock, is probably zilch, zero. So the interest expense to carry the position exceeds the value of the optionality of it. And then you would want to exercise it early. And you'll observe, and I'm sure many of you have, that if you're looking at very deep in the money put options, frequently you're going to find that they are bid below parity, perhaps well below parity, and perhaps below parity by enough that you're going to be able to get out at a push rather than essentially pay somebody else to take it off your sheets for you. So early exercise with puts wasn't really a thing in recent history. It absolutely was a thing back, when I first started as a market maker in the 90s and the 2000s, and we had a normal rate environment. This was something we always looked at. And one of the things we had to think about was that exercising puts early because of the interest expense is not exactly the same as exercising call options early for carry cost reasons like dividend capture. And the reason for that is that interest is a cumulative expense. So when I take a look at the cumulative expense of carrying the strike through the expiration date, that is very different than a dividend, which has a discrete date that matters. So you are entitled to the dividend if you own it before the X date. You are not entitled to it as of the X date or beyond. And so in that case, you have a very specific time at which you must decide whether or not you're going to exercise your call options early. The day prior to the X dividend date, you calculate the net present value of the dividend, you compare that to the extrinsic value of the option, and if the value of that dividend exceeds the value of the option, then, and I'm talking about the optionality of the strike, then you exercise early. Simple. With puts, because each day it's just a small amount of decay. So the question you might want to ask yourself in those cases, now I'm taking it from the other side, you got assigned on short puts, but if you are long puts and you're thinking, oh, do I exercise them or not? The question you need to ask yourself is, well, are there any interim catalysts that I want to capture? Because you're essentially renting that call option. Long stock, long put, you're renting a synthetic call, and some days may be more valuable than others. And maybe you decide, you know what, this it exceeds, the carry cost exceeds the value of the option, but there's a lot that could happen over this weekend, and it could propel this stock, so I want to have that synthetic call. So something to think about there. I realize I'm coming close here to chewing up an hour of your time, so I'm going to try to punch through a couple more of these quickly if I can. So changes in open interest on that, just to button that up. Check changes in open interest relative to the trading volumes. If you have a system that tracks changes in open interest easily, as Bloomberg can, as you can see, I just pull it up there, but I'm sure a lot of brokerage applications can do that as well. Okay. Following up, I remain bullish on the stock, procured 200 shares by allowing a short put to assign it to me at 33.07. Oh, okay. So, Al, this doing exactly what I actually would recommend for these kinds of cases. So stocks that you want to buy, selling cash covered puts, having the stock put to you, and then selling the covered calls, with the exception that as I have said many times, some catalysts I don't favor selling covered calls going through things like earnings most of the time. And I'm not going to take credit for the research, but Matt Amberson and the ORATS guys, they did a lot of research. I read that report a couple of years ago, but I don't have any reason to believe it's changed materially since then. Just didn't show a lot of edge to it. Does that mean it's a terrible idea that options are grossly mispriced and cheap going into an earnings event? No, not necessarily. But what I'm saying is that their research demonstrated that all else equal, you were better off not selling covered calls to earnings. Okay. Greg Forrest says Josh Brown too. I'm assuming, Greg, that you were referring to Corning. Jim P. Mike just exited NVIDIA bull call vertical due to deteriorating chart. Mistake. So this is an interesting case. I hope I shared that. Let's just take a look at NVIDIA. Let's see here. Bull put spread. Okay, so yeah, I assume you mean bull put credit spread, bull call vertical, either or, right? So if you're in a bull vertical, bull call spread, or bull put spread, those, again, synthetic equivalents of one another. They could either be a credit spread, they could be a debit spread. Generally, people will sell put spreads for credits, bull, or buy debit call spreads. But you can, as the stock migrates, one synthetically becomes the other anyway. No, I don't think you're wrong on this. Let's just take a look at a chart here real quick. Oops, why is it? That's very strange. Oh, I accidentally grabbed an option rather than a longer term chart here. I'll say this, NVIDIA had a heck of a run. My friend Carter Worth, he often looks for whether things have gotten extended from a technical point of view. He likes to look at the 150-day moving average. Why don't we do the same thing? And just take a look at how far above that 150-day moving average it had gotten. And as you can see, I'm going back 5 years, it really had gotten well above that moving average. So that would suggest, from my crude understanding, based on the comments he's made to me, that would suggest it was a little bit extended. Other things that one might look at, which could suggest the same thing potentially, things like RSI. I think we had some, very big numbers. We've only reverted back into the mean here, but you can see that we certainly did get extended, as it has done, by the way, a few times in history. And the stock has ultimately recovered, but those periods of very high RSI scores did happen to correspond to shorter term pullbacks in the stock. So I don't think you were making a mistake by reducing your position when things got extended the way they have from a technical point of view. The thing that I tend to look at is also relative performance. And the thing that I noticed was that the S&P was broadening, that we saw the S&P holding up very nicely. We've seen some other stocks sort of coming back to life. We just talked about one of them, which was all but left for dead, moribund in Intel, relative to names like NVIDIA. And the relative strength to itself, the RSI, was very high, but the relative strength to the broad market and some of the comps was very weak. And all of those things together extended well above the moving average. High RSIs, the fact that it started to underperform relative to its peer group and relative to the market, all of those suggested some short-term weakness. So no, I don't think that was a big problem. So there. Okay. Jay Lemur, I watch you later at night every week, have errands after market close lately. Anyways, wanted to tell you thanks for the info and education. I appreciate what you do. Well, thank you for that. I'm glad that people are tuning in even when they can't do so live. And okay, here we go. So can you take a look at IWM since it's been lagging all of the other indices? So the Russell 2000, this is an interesting thing because actually that underperformance, I think, actually, let's just take a look at it in a different way and go like this. I'm going to go back to that in a second. Oh, sorry. let's just compare it to, we'll compare it to the Qs, we'll compare it to the diamonds, we'll compare it to SPY, and just take a look at what we're dealing with. And talk a little bit about the dynamics that affect different businesses and how, how they're doing. So, not a big surprise. QQQ propelled by the big winners in the AI space, such as the names we were just talking about, NVIDIA and so on. So they were going to outperform just on the strength of their biggest constituent stocks. But in a broad market context, what are the headwinds that the Russell 2000 specifically might face recently? Well, the general economy hasn't been as good as those idiosyncratic growth stories. So the AI thing, that you're not going to find those stocks typically in the Russell 2000. The Russell 2000 are the smaller cap companies. These companies tend to have less cash on hand, they have higher interest rate expense and depend more on it, and they are not going to typically contain some of the the biggest high-flying names. It's interesting because I hear this all the time. Russell 2000, now's its time. Now is the situation where it's going to play catch-up. How often have you heard people talk about that? Small caps, underperforming for ages, and now they're going to catch up. Well, that's kind of an interesting thing to say when you think about it, because the S&P 500, by its very nature, is going to contain essentially the 500 biggest winners. And they have the advantage, by the time they get to that size, scale, and scope, of, generally speaking, having access to cheaper capital, brand recognition, and probably thematically have the wind at their back. Not necessarily true for small cap companies. So I've always found that argument to be, this is the time for small caps, rather interesting, because they'll never have any of those other advantages. Not least of which is being a winner, which the S&P 500 stocks are, or the Russell 1000 stocks for that matter. So I do find that to be a little bit interesting. Look, I would really like to see sort of the headline. Two things are going to be needed for the small caps. One is that we do need to see rates for them, their borrowing costs, remain low. So if we have anything pushing up the long end, I actually think that's going to be even worse for them. One way to think about it is that I guess I kind of think of the Russell 2000 stocks. We think of those companies whose future earnings are what everybody's playing for as being long duration. But companies that have to constantly borrow a lot of money and roll over that debt and bear the brunt of rising interest rate expense, they kind of have a lot of duration too, so they don't benefit from rising rates. So I guess I see some rationale to that. Chipotle. Okay, so some of these restaurants, yeah. I think, was it a couple weeks ago, I made a comment that I thought that Chipotle had run a bit too far, too fast as well. Obviously, it has suffered a little bit of a pullback. I guess it's a little easy for me to say, I thought it had done a little bit too much and not to really make that bullish play in it because of that sort of extended run. I will say, though, if this one reverts back to this 150 or slightly below, I went to a Chipotle recently. The line was to the door. I saw plenty of cars come and go just because the line was too long. My own kids love it. It seems to be a good story. The owner of the Applebee's franchise that operates in Times Square, which is a rather famous one because they sell these really expensive tickets to the New Year's celebration. Everybody goes there and they have a big New Year's party. He made an interesting observation on Fast Money a couple of weeks ago, and the comment he made was twofold, that one, people have to eat, and we're creatures of habit. So if you're used to going out on Friday night or Saturday night, it's kind of hard to break. The other observation he made was that while there has been some fairly significant price appreciation in some restaurants, that in many cases the rate of price appreciation at the restaurants has not been as extreme as it has been at some of the groceries. And also consumers are sort of modifying their choices a little bit, choose chicken rather than steak, that kind of thing. They're holding up better than I thought they would. And actually, even as I thought about my own habits and our own family's habits, I kind of saw that. So pizza, by the way, I should say, kind of interesting there because you kind of think about whether it's Papa John's or whether it's Domino's, DPZ, or any of these. If you think about automation, labor costs, and things like that, these guys should, in theory, at least, be able to benefit in ways that some of the other sit-down, fast casual dining restaurants aren't necessarily able to. Papa John's, of course, has had its own problems, management problems, after the founder and CEO had to step down. Let's just take a quick peek. How is this thing doing right now and see where it is relative to its own historical valuation? Wow, this is a really speedy connection I've got here. All right, so 17 times forward earnings. That's well below its own historical average. It is below its peer group. You may or may not be able to see the table here, which includes Cheesecake and a bunch of other companies, but you can see it's trading at a discount. The discount that I'm talking about relative to its own historical valuation is these numbers up here, right? So price to the forward earnings estimates at the lowest end of the range that we've seen in the last 2 years. Enterprise value to EBITDA. I'm not necessarily saying that EBITDA is the best measure. It sort of became a habit for people to think of that as an alternative free cash flow. Maybe EBIT would be a better way to think about it, because depreciation and amortization, these are real expenses and we should not ignore them. Take a look at CapEx, take a look at depreciation, take a look at amortization. These things do matter. Price to, the enterprise value to revenue. It's cheap. The real question that you have to ask yourself is, okay, fundamentals, it's cheaper than it has been, but where do we draw the line? And, what the heck? Why don't we just go ahead and draw one right here and now? This is the pandemic low down here, $28. So it's 44 now. Let's just say that's an extreme washout. Let's just pick this number right here, which is around about $40. Not far off of where it was trading pre-pandemic and all that. I have to say, I think that it's probably getting to a point where it's attractive. Don't know if that helps. Chipotle, I think, is expensive, but boy, they're lining them up out there. And Papa John's, I think, it might be a painful ride, but fundamentally, it's not a bad place. And let me see. I had one. Let's see. Restaurant menu prices don't go down, but groceries go down if no inflation. Another good point. So you're kind of putting on a fixed versus floating spread there, right? So if their input costs go down, so if we start to see a normalization in food prices, but they keep the same prices and you still get foot traffic, what just happened? Wider margins. I'm, of course, ignoring the fact that labor costs also don't go down. It's very tough to go to people and say, hey, we gave you a raise, $20 an hour, $25 an hour, things like that, and now we're going to take it down. Do you still suggest buying August puts on SPY for a hedge? Yeah, I think they're cheap, right? And market's up a great deal. Puts, I think it's a reasonable thing to do. I will also say that I've been reading a couple other derivative strategists putting out their pieces. I think Bank of America put one out, and they were recommending hedging. Goldman recommended hedging. And I started to think, oh God, you know, I'm recommending hedging, and so is everybody else. And if we're all recommending hedging, then that's probably not going to be a hedge that pays off. But I do, because I think they're very reasonably priced. You know, the market's had a heck of a good run here. It's already up more than the average year, and that's coming off the back of another great year, right? Okay, so with that, I've occupied a full hour and then some of your time. So for those of you who gave that time to me, I really do appreciate it. Like, subscribe, tell your friends, get them to watch, get them to send questions in, comment, and all that kind of good stuff. And be sure to tune in again on Wednesday when I'm going to be talking about JB Hunt. So they report on the 16th. And, you know, it's another industrial, hasn't been performing really well. I think it might be a little bit different story than Fastenal, just based on valuation, things like that. So we're going to talk about that on Wednesday at 4:15. Tune in for it. Thanks for watching.